Currently, there's a $28 disparity between silver prices in New York and Shanghai. This isn't a mere $2 difference or a $5 premium, but a substantial $28. Silver trades at $75 per ounce on COMEX, while the same silver in Shanghai fetches $130 per ounce. In an efficiently functioning market, such a gap should not persist for more than 28 seconds, let alone 28 days. Every trading algorithm on Wall Street, every arbitrage desk at major banks, and every hedge fund with a commodities team is aware of this discrepancy. Yet no one is closing it. They can't, because it's impossible to arbitrage what you cannot physically acquire. Welcome to the Independent Financial Historian. If you're new here, I reveal the mechanisms behind market disruptions that mainstream financial media often overlooks. Subscribe now, because what I'm about to present isn't speculation. It's grounded in cargo manifests, vault inventories, and refinery throughput data, all of which confirm that the largest wealth transfer in the history of precious metals is currently unfolding. Hit the like button if you appreciate this kind of analysis. It helps this information reach those who need to understand these developments. Here's how arbitrage is typically supposed to function. A trader observes silver priced at $75 in New York and $130 in Shanghai. They would purchase it in New York, ship it to Shanghai, sell it for $130, and pocket a $55 profit per ounce, subtracting shipping expenses. The cost for shipping and insuring silver from New York to Shanghai is approximately $2 to $3 per ounce. Converting a COMEX good delivery bar into Shanghai kilogram bars incurs an additional $1.50 in refining fees. So, let's estimate total logistical costs at $5 per ounce. This leaves a $50 per ounce profit on a container holding 25,000 ounces, translating to $1.2 million in pure arbitrage profit for a 3-week turnaround. Every algorithmic trading desk globally is programmed to execute such trades. So, why does the gap remain? The $75 COMEX price assumes you can actually purchase physical silver at that price. It assumes COMEX holds metal in its vault, that you can take delivery, and that refineries can convert your bars within reasonable timeframes. It also assumes you can export the refined silver from the United States without regulatory delays, and that Chinese customs will process your shipment without complications. If any of these assumptions are invalid, the arbitrage opportunity vanishes. And currently, every single one of these assumptions is broken. Here's why. COMEX registered silver inventory, metal actually available for delivery against futures contracts, was 356 million ounces in January 2021. This was after 5 years of a functioning market with normal delivery operations. As of late January 2026, COMEX registered inventory stands at 113 million ounces. Read those numbers again. 356 million down to 113 million. That's a 68% decline in deliverable inventory over 5 years. But it gets worse. Reports from early January 2026 indicate that within a single 7-day period, 33 million ounces of silver left COMEX vaults. This wasn't traded. It was physically removed, loaded onto trucks, and gone. In just 1 week, more silver departed COMEX than some entire national reserves hold. COMEX currently has 500 million ounces of open interest in silver futures. 500 million ounces in contracts that theoretically promise delivery. However, only 113 million ounces of metal are actually in the vault, available for delivery. This represents a ratio of 4.4 to 1. For every 1 ounce of real silver in the COMEX system, there are 4.4 paper claims against it. If just 23% of contract holders demand delivery, the vault would be completely empty. Not merely stressed or tight, but empty. Now, connect the dots. On January 1st, 2026, China reclassified silver as a strategic export-controlled commodity. This wasn't a recommendation or a tariff. It was a firm control. Silver is now categorized alongside rare earth elements and military technology. Under these new regulations, only 44 state-approved companies are permitted to export silver from China. Not 400, not 40,000 independent traders, but 44 government-approved entities. To qualify, a company must produce at least 80 tons of silver annually and maintain substantial financial reserves, effectively limiting participation to state-owned or state-connected enterprises. Here's what this means in practice. China refines 60 to 70% of the world's silver. Most of this refining involves imported silver concentrate from mines in Mexico, Peru, and Australia. Historically, China imported the raw material, refined it into London Good Delivery bars or Shanghai Gold Exchange kilos, and then re-exported a portion back to global markets. That loop is now broken. China still imports the concentrate and still refines it. However, this refined silver now remains in China unless the government explicitly approves its export through one of the 44 licensed entities. And these approvals are being granted to Chinese solar manufacturers, Chinese EV battery makers, and Chinese electronics companies, not to London dealers attempting to cover short positions or New York arbitrage desks trying to close the COMEX-Shanghai gap. Draw your own conclusions about whether the timing of January 1st, precisely when COMEX inventories hit crisis levels, was coincidental. Imagine you're an arbitrage trader. You finally secured 10,000 ounces of physical silver in New York at $80 per ounce. You paid a $5 premium over COMEX because no one is really selling at $75 anymore. That's merely the futures quote. Still, you're eyeing a $40 arbitrage profit in Shanghai. Now, you need to convert your COMEX Good Delivery bars into Shanghai Gold Exchange kilogram bars. A COMEX bar weighs 1,000 troy ounces, approximately 31 kilograms, while a Shanghai kilo bar is 32.15 troy ounces. You can't simply ship COMEX bars to Shanghai and sell them. The Shanghai Gold Exchange does not accept them for settlement. You must recast them into kilos. There are perhaps 6 refineries globally with the capacity, accreditation, and throughput to perform this conversion at scale. Perth Mint in Australia, Heraeus in Germany, Pamp Suisse, and a handful of Chinese and Indian refineries. In normal times, the turnaround is 1 to 2 weeks. These are not normal times. Refineries are currently quoting 4 to 8 week delivery windows. Why? Because every arbitrage desk, every industrial user, and every sovereign wealth fund attempting to source physical silver is encountering the same bottleneck. Refining capacity is finite. You cannot just establish a new LBMA-accredited refinery in 90 days. So, you wait 8 weeks. While you wait, silver prices fluctuate. Perhaps COMEX drops to $70 as more paper selling hits the market. Perhaps Shanghai spikes to $140 because Chinese manufacturers panic buy. Your $40 arbitrage profit has just turned into a $20 loss, and you haven't even shipped the metal yet. This is why the gap persists. The mechanisms for closing it are broken. But here's the part that kept me awake last night. There's an economic principle from the 1500s called Gresham's Law. Sir Thomas Gresham, an advisor to Queen Elizabeth I, observed that when 2 forms of money circulate simultaneously, one with genuine intrinsic value and another debased or backed by questionable promises, the valuable money disappears from circulation while the questionable money remains. Bad money drives out good. When Henry VIII debased English coinage by reducing its silver content while maintaining its face value, merchants immediately began hoarding the old, full-weight coins and spending the debased ones. Rational actors retain assets with real value and pass along substitutes with uncertain value. We are witnessing this play out in real time in the silver market. On one side, you have physical silver metal you can hold, metal sitting in an allocated vault with your name on specific serialized bars, metal that cannot be created through financial engineering, genuinely scarce. On the other side, you have paper silver, COMEX futures contracts that promise delivery but settle in cash 98% of the time. Silver ETFs with force majeure clauses that allow them to suspend physical redemptions during extraordinary market conditions, a term the prospectus does not define. Unallocated silver accounts where your claimed ounces are actually shared fractionally across multiple account holders. For decades, these two forms traded at the same price because they were functionally equivalent. If you held paper silver and wanted physical, you converted it at par, no problem. That equivalence is now breaking down. The $75 COMEX price reflects the value of paper, contracts backed by a system where 4.4 claims exist for every ounce of physical metal. The $130 Shanghai price reflects the value of actual physical silver you can touch, store, and use without counterparty risk. Gresham's law predicts precisely what we are seeing. Holders of physical silver refuse to sell it at paper prices. They hoard it. They wait for physical prices to reflect true scarcity. Meanwhile, paper floods the market because holders realize those claims might not convert to metal at the stated price. Bad money is driving out good. Here is the smoking gun. Observe what sophisticated money is doing. The iShares Silver Trust, ticker SLV, is the largest silver ETF in the United States. It holds silver in unallocated form, meaning your shares represent a claim on a pool of silver, not specific bars. Its prospectus contains force majeure language, allowing the trust to settle redemptions in cash instead of metal during market disruptions. SLV experienced significant outflows throughout late 2025 and early 2026 as investors liquidated their positions. Simultaneously, the Sprott Physical Silver Trust, ticker PSLV, has seen record inflows. PSLV holds 100% allocated physical silver, London Good Delivery bars stored in Royal Canadian Mint vaults with full audit transparency. Every share represents ownership of specific serialized bars. You can redeem for physical metal without force majeure exceptions if you hold enough shares. On January 20th, 2026, Sprott announced they were doubling their at-the-market equity program from $1 billion to $2 billion. This capital influx enables them to acquire roughly 18 million additional ounces of physical silver. This 18 million ounces represents 16% of the remaining registered inventory on COMEX. A single trust is poised to buy 16% of all deliverable COMEX silver. This is not driven by retail panic. Rather, it's institutions with multi-billion-dollar research budgets and legal teams that have scrutinized every line of every prospectus. They are shifting capital from paper assets with force majeure clauses to physical assets with guaranteed allocated metal. They understand what is imminent. Now, consider this intriguing development. Technology companies are completely bypassing exchanges to secure physical supply directly from the source. Tesla reportedly acquired 85 million ounces of physical silver in mid-January 2026. This wasn't through COMEX futures or SLV shares. It was 85 million ounces of physical metal secured via mine contracts, vault acquisitions, and off-market deals orchestrated over 72 hours. This purchase is equivalent to 75% of the total registered COMEX inventory. Tesla effectively bought 3/4 of all silver currently available for delivery on COMEX, and they did so without engaging in public markets. Samsung, similarly, negotiated an exclusive offtake agreement for 100% of the La Perla silver mine's output for 2 years. They own the mine's production before it is even extracted. This silver will never enter a vault or trade on an exchange. It goes directly from the refinery to Samsung's battery production lines. Apple, according to reports, has run internal simulations modeling silver supply disruptions. Their worst-case valuation reached $573 per ounce. This isn't because they view silver as an investment worth that much, but because the cost of a production line shutdown due to a lack of silver components surpasses the expense of paying $500 per ounce to secure supply. When an iPhone assembly line generates $200 million per day in output, paying any price for guaranteed silver supply becomes economically justifiable. Reread those figures. Tesla removed 85 million ounces from the market. Samsung locked up 2 years of mine output exclusively. Apple is prepared to pay $573 per ounce if necessary. These companies are not speculating on silver prices. They are acknowledging that the commodity exchange system can no longer assure supply. Consequently, they are integrating backward, securing upstream production, and completely removing silver from tradable markets. They are hoarding the true money. So, what happens next? The $28 gap cannot be closed through normal arbitrage, because every mechanism essential for arbitrage to function is broken. Mechanism 1. Supply response to price signals. In typical commodity markets, if prices double, miners increase production, existing mines expand operations, new mines are financed, marginal deposits become viable, supply grows, and prices moderate. Silver doesn't operate this way. 70% of mined silver is a byproduct of zinc, copper, and lead extraction. Silver supply is constrained by base metal economics, not silver prices. A copper mine facing declining ore grades will reduce output even if silver is at $150 per ounce, because the mine's economics are driven by copper, not silver. Price signals do not increase silver supply within any relevant time frame. New silver mines require 7 to 10 years from exploration through permitting, financing, construction, and initial production. A mine beginning production in 2026 reflects exploration decisions made in 2016, when silver was $15 per ounce. Projects responding to 2026 prices will not produce metal until 2033 or later. The market cannot wait 7 years. Mechanism 2. Demand destruction. In normal markets, when prices surge, demand collapses. Consumers find alternatives or defer purchases. This is not occurring with silver. Solar panel manufacturers cannot halt production because silver costs have spiked. They have contracts, installation deadlines, and government subsidies with expiration dates. They will pay the higher silver price and pass costs on to customers, or they will shut down entirely and destroy shareholder value. They will pay. Electric vehicle manufacturers developing solid-state batteries with silver carbon anodes cannot substitute copper or aluminum. The technology demands silver. They either secure silver supply or abandon their entire product line after billions in R&D investment. They will pay. AI data centers cannot postpone construction because silver has become expensive. Power density requirements and thermal management in high-performance computing necessitate silver. The cost of delaying data center deployment far exceeds the cost of expensive silver. They will pay. This is inelastic demand, meeting constrained supply with broken arbitrage mechanisms. The gap does not close, it widens. Here's what I'm monitoring. COMEX March 2026 silver contracts comprise over 500 million ounces of open interest. Registered inventory stands at 113 million ounces. If even 23% of those contracts demand physical delivery instead of cash settlement, COMEX cannot fulfill the obligation. Every COMEX futures contract includes a force majeure clause. This language permits the exchange to suspend physical delivery during extraordinary market conditions and settle contracts in cash at a price determined by the exchange's settlement committee. That wording is deliberately vague. The exchange defines extraordinary conditions. The exchange sets the cash settlement price. If COMEX invokes force majeure on March contracts and forces cash settlement at, say, $85 per ounce, while physical metal is trading at $130 in Shanghai, what happens? Every futures trader holding contracts expecting $130 metal gets settled at $85. A $45 per ounce loss imposed by exchange fiat. That is not a market. That is expropriation. The damage to COMEX's credibility would be terminal. Every industrial user, every sovereign wealth fund, every institution that relies on futures for hedging would recognize that COMEX can no longer guarantee physical delivery. The migration to physical markets would accelerate overnight. Shanghai would become the global price discovery center by default, because Shanghai still delivers actual metal. I am not predicting this will happen. I am telling you, the mechanics exist for it to happen, and inventories are at levels where it becomes possible. Possible is enough to move markets. Here's what I'm watching over the next 60 days. 1. COMEX registered inventory. If it drops below 100 million ounces, the math becomes impossible to ignore. We are currently at 113 million. One bad week of withdrawals puts us there. 2. Shanghai physical premiums. If the premium over COMEX exceeds $40 per ounce and sustains for more than 2 weeks, it signals that arbitrage has entirely failed and the markets have permanently bifurcated. Sen. Silver lease rates. These are the costs of borrowing physical silver against dollar deposits. Normal lease rates are below 2% annually. In late 2025, they spiked to 35%. If lease rates exceed 40% and hold for more than 72 hours, it means physical silver is unavailable at any reasonable cost in London and New York. 4. Refinery delivery windows. Currently quoting 4 to 8 weeks. If major refineries extend quotes beyond 12 weeks or stop accepting new orders entirely, the conversion bottleneck has become total gridlock. 5. ETF divergence. Watch the SLV to PSLV premium. SLV is unallocated with force majeure clauses. PSLV is allocated without force majeure protections. If PSLV shares start trading at a 10% or greater premium to net asset value, while SLV trades at a discount, it means institutions are pricing in the probability of SLV force majeure settlement. These are not speculative indicators. They are mechanical measures of system stress. When multiple indicators flash red simultaneously, the system is in failure mode. Markets like this separate survivors from casualties, not based on who predicted the exact top or bottom, not based on who had perfect information, but based on who recognized the structural break and positioned accordingly before the crowd understood what was happening. Physical silver holders recognized months ago that paper and physical were decoupling. They moved capital into allocated metal and removed it from exchange vaults. They are not checking prices every 15 minutes, panicking about drawdowns. They are waiting for the inevitable reconciliation between paper and physical. Paper silver holders, traders in COMEX futures, holders of unallocated ETFs, are now discovering that their $75 positions do not convert to $130 metal. Some will face force majeure settlement at exchange-determined prices. Some will exit at losses. Some will hold and hope the gap closes through mechanisms that no longer function. They are casualties of a system that promised fungibility between paper and physical, and that promise is breaking. Someone will survive this. Someone will hold physical metal through the panic and sell it when clarity returns, at prices that reflect true scarcity. Someone will recognize that the $28 gap is not an arbitrage opportunity. It is a signal that the commodity market structure is collapsing. That could be you. Or you could be the trader who assumed COMEX delivery would always work, right up until the exchange declared force majeure and settled your position in cash at a 30% discount to physical. One of those outcomes involves understanding what you just watched. The other involves assuming the system still functions the way it did 5 years ago. Choose accordingly. Drop your thoughts in the comments. Are you holding physical or paper? Are you watching the COMEX registered inventory? Have you tried to source physical silver from a dealer recently and faced delivery delays? I want to hear what you are seeing on the ground, because the data I am tracking is macro level. Your direct experience fills in the gaps that vault reports do not show. If you found this video beneficial, please share it with someone who could use this information, not for algorithmic engagement. Many individuals holding paper silver are unaware of the force majeure clauses in their prospectuses. People are incorrectly assuming that a $75 COMEX price means they can purchase physical silver at $75, and this assumption will prove costly. Sharing this video could be the deciding factor between someone making an informed choice and someone realizing too late that they are party to a breached contract. If you haven't already, subscribe to this channel. I am tracking the silver decoupling daily until it reaches a conclusion, whether that's through a COMEX force majeure leading to a formal market bifurcation or by Shanghai premiums narrowing as supply somehow stabilizes. Regardless of the outcome, you will find it analyzed here first, utilizing vault data and cargo manifests that financial media typically overlook. See you tomorrow. We're just getting started.